Thanks for watching this Magellan update. Today I'm speaking with co-founder and lead portfolio manager, Hamish Douglass. Hamish, the obvious macro issue at the moment is the risk posed by a Trump-China trade agitation. How do you view that potential issue?
Well, it's very interesting how you frame the question, because Trump isn't just attacking China on trade, he's actually attacking the European Union, and particularly Germany. He's also attacking NAFTA, which is Mexico and Canada as well at the same time. But I would actually split them. I think your question is right to focus on China here, because I don't see the issues in Europe and the issues in NAFTA as being deeply strategic. I think Trump is really going for a transaction there, maybe even up some tariffs, do a deal to look like there's more manufacturing in the United States, attack the trade deficit to the extent that he considers that's a problem. So I think those issues will get resolved. It could have a lot more noise associated with it, but I don't think that's going to lead to long-term issues. The China issue is actually a lot more complicated, because at the heart of the China issue, there is actually a deep long-term strategic issue. China is rising as a world force, and at the centre of that power of China is they're very focused on some very strategic industries that are in a 2025 development plan that China has announced, and they include things like supercomputers, semiconductors, 5G telecommunications networks, driverless cars, artificial intelligence. It's all about where the future is going, and they want to have a stake, a dominant stake at this table. So at the centre of this dispute is technology and who is going to reign supreme. The United States and a number of hawks in the United States realise that this is a big issue of confrontation about the theft of intellectual property, students in the United States who are being educated, who are going back to the United States, and is there a fair exchange that is occurring here? What I can't tell you is where President Trump sits on this issue. Is it to just do a deal that he can sell back to the population of America that is evened up the ground, but not actually address the fundamental issue that goes to technology and dominance in the longer term? If he wants to really challenge China on that issue of technology supremacy in the longer term, this is not going to be solved quickly. We could have a very prolonged and a very ugly war. I don't think that's going to happen with the Canadians and the Mexicans and the Europeans, because we haven't got the heart of it about theft of intellectual property and things sitting there. There are a number of people who appear to be deep in the president's ear who have actually identified this is a very important long-term strategic issue for the United States. So I think when you look at the China situation, you have to make an assessment. Is the president just transactional, that just wants to do a deal, or does he fundamentally want to dig in and try and solve this long-term technology supremacy question between China and the United States? I actually don't know. If it's the latter, we could be in for a much deeper and much more prolonged and a much uglier scenario, because the Chinese are not going to they're going to push back very hard. Will they do a deal about tariffs and everything and buy some more planes from America? I think they'll do that deal in a heartbeat. But will they fundamentally go and give up ground on where they want to reign supreme in the longer term? You're talking a much deeper issue, and I think China will dig in and it could actually get pretty ugly. Which way are those cards going to fall? I don't know, but we're prepared for either.
And so, Hamish, if it does get ugly, what's the potential impact on the strategy, on the portfolio?
Well, first of all, I'd say we're running our most defensive portfolio since we've run in 2009. We're sitting at around 18% cash in our global equities portfolios at the moment. So that's an important bearing. Secondly, we don't have a lot of manufacturing in the portfolio, a lot of exporters in the portfolio exporting manufacturing goods where tariffs could apply. That we could really be harmed. That's not a core part of what's in our portfolio. We do have some exposures to China. Broadly, we've probably got 4 businesses that have relatively large Chinese consumption businesses. Apple would be one of those. and then Starbucks, Yum Brands, McDonald's would be the other ones. In aggregate, they're probably around 15% of our portfolio, but the China see-through exposure is less than 20% of our portfolio. So, maybe 3% of our portfolio could get ugly if we got a very prolonged battle between China and the United States on this topic. That 3% could be harmed for a period of time. We don't think it's that material in the context of our portfolio, and as I say, we don't have a lot of industrial manufacturing exporters. We've virtually got none of those in the portfolio. But if this got ugly, all stock markets could be affected. So we may not be at the pointy end of things that will be most affected outside that exposures I've talked about, which is very modest, but all equity markets could be affected if we really went into a trade war between China and the United States, which we're not in at the moment, by the way. People may think we're in it. We're not in a trade war. And the markets are actually thinking this is just going to be a transaction. If you look at how the markets are behaving, outside of sort of the Chinese and Hong Kong market at the moment, it's been very, very benign. So the markets are largely pricing that a deal's going to be done and this isn't going to get deep and ugly.
Hamish, you've recently commented on the potential for a 20 or 30% correction in markets on the back of rising interest rates. Maybe you could expand on that a little?
Yeah, well, first I'd say we're not predicting that. We think the probabilities of a market correction are very elevated at the moment. That doesn't actually mean it's going to happen. It just means people have to be very mindful and cautious. We're in an environment that's actually quite dangerous at the moment. What could lead to that? Well, first of all, I think we have to recognise around the world is most equity markets and most asset prices are at or near all-time record levels. At the same time, the major central banks of the world, and I'd put the US Federal Reserve and the European Central Bank, have actually announced plans over a 12-month period to withdraw around $1.5 trillion of liquidity from markets. So they are going to be out of the markets demanding far fewer assets. So they were buying under quantitative easing massive amounts of bonds in the world. They're effectively going to be withdrawing that liquidity from markets over the next 12 months up to December this year. So that's going to have pressure on interest rates going upwards. We've also got another very important element here, and that really comes to the state of the US economy. The US economy is in great shape at the moment. Unemployment is at a 20-year low in America on any measure you look at. And the Trump administration has announced a very large fiscal stimulus over the next 2 years, both tax cuts and expansion of the budget, probably about 2% of GDP each year for the next 2 years, at a point that the economy is humming and unemployment's very low. So we've got this cocktail of very unusual circumstances in history. The biggest risk for markets is we get a jump in long-term interest rates here. And there are a few scenarios that could play out. The principal ones is the Federal Reserve and the ECB continue on their plans and the stimulus in the economy doesn't trigger wages growth of any material aspect in the economy. If that happens, I think we'll just get slowly rising interest rates, a bifurcating market where certain assets will do well and certain won't do well, but the economy is pretty strong, but we don't get a major correction in markets. The other side of that equation is we actually get some meaningful wages growth in the economy over the next 12 to 18 months or so in the United States. And the US Federal Reserve is behind the curve of where they need to be from the monetary policy point of view, and the market quickly reprices where the Federal Reserve has to go, and we could get a big jump in long-term bond rates, maybe to 4.5%. They're currently around 3%. If that was to occur and occurred rapidly, I think it's very foreseeable that markets could correct fairly quickly at 20 to 30% level. Will that happen? Won't that happen? It really depends what happens on wages growth in the economy. Wages have not been growing rapidly for the last 9 years through this economic expansion. History would tell you at some point there's going to be a point of inflection, but there are some very strong secular forces at work in many economies of the world that are keeping wages growth low. But will we get a point of inflection in the United States over the next 12 to 18 months? I think it's 50-50, which is a very polite way of saying I don't know. at the end of the day. But I do think with this cocktail of circumstances, the risks are elevated at the moment and people should not be complacent. I think if a market correction happens, it may be 50-50 at the moment, and I think it's foreseeable. It does not mean it's going to happen, by the way.
And so, Hamish, what are some of the signposts or signals that investors and advisors should be looking out for?
At the end of the day, I really think it's US economic growth and wages growth. If we go back to the 2nd of February this year, it was a very important day because that was the day the Department of Labor announced the January wages growth number, and it came in at 2.9%, and shortly thereafter the markets corrected by around 10 percentage points. When we got into March and we saw the February numbers, wages growth had come back to about 2.5%, and the market said, oh well, we're in Goldilocks moment again, rates aren't going to go up rapidly, and we're back to the races. So I think that wages growth number and the economic growth in the United States is absolutely key here, and it's probably the most important economic statistic that the market's going to be reacting to. It's likely if we get a wages growth number above 3%, the Federal Reserve won't do anything in reaction to the first one because they don't want to act too early or preempt. The risk is we get a second one that accelerates further, and then the markets go, the Federal Reserve's behind the curve here. So I would focus on absolute economic growth, and I would really focus on the wages growth number in the United States. It's probably two key statistics that markets will be watching, and I would suspect investors, if they're interested in this, it would probably be something to focus on.
And so, Hamish, over the last little while, the strategy has increased cash to around 18%. Maybe talk us through some of your thinking there?
Yeah, well, we really increased our cash weighting. We've been running about 8% in the strategy, but we increased it to 18%, and we really did that around the time when the big tax cuts came in the United States, because we said this is adding a very late cycle economic stimulus to the United States, which really has changed the uncertainty of what can happen looking out. So the uncertainty that the Federal Reserve is behind the curve and monetary policy are much tighter has the probabilities of that suddenly change with these massive tax cuts and then the subsequent agreement to increase the budget deficit on top of that in the next few years. So that was the crux point that put another fact on the table that made us dramatically reassess our probabilities of something adverse happening there. And then, of course, we've got the trade wars and other issues, which will probably just add to the cautiousness that we have at the moment.
Thanks, Hamish.
A pleasure, Frank.
And thanks for watching. And as always, feel free to forward this link on to clients or colleagues where you think they might be interested. Thank you.